Hello and welcome to a special Tariff Talk edition of The Upside. I'm Kyle Sharapita. So, what is a tariff? Tariffs are taxes imposed by a country on imports from another, a varying percentage of the value of that import. In the US, the tariffs are paid by the importer to the US Treasury, collected by the Customs and Border Protection agents. As far back as November, then President-elect Trump hinted at the possibility of imposing tariffs. And now, in early March, the tariffs have been threatened, delayed, implemented, adjusted. It's been a lot to keep track of and is a fluid, developing story. Today, we have comments from 5 Fidelity experts to unpack how they are staying informed and level-headed while aiming to protect investors' hard-earned savings. What you'll see today was recorded between March 3rd and 6th, a week with a lot of tariff headlines. Fidelity is well positioned to understand situations like this because of our diverse asset management teams, vast research resources, access to companies, and prior experience in times of market-impacting news. And to start us off, here's Andrew Marchese, Portfolio Manager and Chief Investment Officer here at Fidelity Canada Investment Management.
Good day, everyone. Trade tariffs between the United States and long-standing trade partners, Mexico, Canada, China, are gripping global stock markets. The markets are fraught with uncertainty at this point in time, and we've now ventured down a road that many people thought we would not be venturing down when we started this calendar year. I think the implications are quite vast, and the spectrum of outcomes are also very diverse. But for investors, I think there's a number of things that one has to keep in mind as we sit here today. One, while we know the amount of the tariffs and the industries, sectors, goods, and services that are implicated today, one really has to ask ourselves about duration and how long these tariffs between these countries stay in place. That is quite unknown at this time, and there will be a lot of changes as time transpires. It is important as investors that we don't react to what we see initially in headlines, but rather apply a much more thought out and deliberate approach. As always, we have to keep corporate profits at the forefront of our investment decisions and track those where they will go, not just over a short period of time, but over a mid to long range period of time. The other thing that we have to consider a lot is monetary response by central banks. If indeed these tariffs last for a prolonged period of time, one can expect slowing of all the economies in all the countries that are implicated. But that will not be a static event. We could expect global central banks to react in kind by cutting rates to hopefully stimulate economies. Moreover, different industries and sectors are not equally implicated. For example, the United States has made mention about NATO allies pulling their weight, so to speak, in terms of defense spending. We must ask ourselves, do various NATO allies increase spending on defense, and what are the implications for companies in those respective industries? So while trade is affecting in possibly a negative sense many industries and sectors, it may have some actually positive benefits for other industries and sectors. The other thing that we have to consider is the market generally historically can react well to good news. It can actually also react favorably to bad news. What it generally doesn't react well to is uncertainty. And at this point in time, we are speaking to our companies, and I think various industries are still trying to put their heads around about what are the implications for their businesses going forward. As time unveils itself, we can expect there to be a little bit more clarity with respect to the companies in the affected industries, and they may have a better outlook and a better message for investors going forward. In the interim, as we entered this year, stock market valuations, particularly in the United States, were relatively high, and we could expect some multiple compression in that standpoint, but also we saw other countries' stock market multiples somewhat compressed. It would not be surprising to see a rotation of flows from the US-dominated center of the market to other countries who may not have large sectoral implications and whose valuations could actually expand from this point. And then the last factor we have to consider that goes hand in hand with growth, it also goes hand in hand with monetary response, is the currency implications globally. And for us sitting here in Canada, continued downward pressure on the Canadian dollar is a distinct possibility if the Bank of Canada continues to react by cutting rates going forward. They have already led the US in this respect, cutting rates more so than the US in 2024. And if economic growth slows considerably, one could expect that the Bank of Canada would react in kind. So those are the implications that we are thinking about today. Obviously, there's more questions than answers, but I think the 4 points that I've outlined for you actually form the foundation of where to look for answers. As always, keep long-term investment goals in mind, keep diversification as your forefront, and try not to react to the headline news that we see before us today, but rather setting out an investment goal and directive for the medium to long term. Thank you very much for your time and attention.
So going chronologically through the week, next up is portfolio manager Dave Way, who manages Fidelity Long-Short Alternative Fund.
The one thing that we can all count on as investors is uncertainty, and today's uncertainty relates to trade. And I think the one thing that we always try to focus on at Fidelity is finding opportunity. And situations like this, where we see significant dislocations, often make people like me very excited about the opportunity to find companies to invest in. Uniquely, I manage a long-short fund. So on the long side, I'm really looking for companies that have been unfairly painted with a negative outlook related to all of the issues currently happening. And one of the things that excites me is when I can find good companies that I'd like to own and are now available at a significantly better price. One thing that's really unique about being a long-short manager is that I can also look for companies that might be vulnerable to the likely policy outcomes. Perhaps not the headlines that we're seeing today about what happens with tariffs, but the ultimate landing spot that we see. And so on the short side, what I'm looking for are companies that are vulnerable to changes in trade patterns, differing employment outlooks, as well as broader economic challenges that may emerge. And for me, it's a really nice place to be because I can really try to find opportunity. And as the market continues to show some volatility, I actually have opportunities to generate returns for clients from the short portfolio while continuing to build the long portfolio of stocks that I'm excited about in the medium term, notwithstanding some of the scary headlines we're seeing today. From a team perspective, we're doing what we always do. Fidelity has a large army of analysts who are continuing to meet with companies. I'm sure we've met with hundreds in just the last month alone. I've met with 50 companies in the last month who are directly exposed to the tariff risks and moving beyond the headlines to find out what exactly is going on within companies. And I can tell you that what you're seeing in the media versus what's happening in companies is quite different. And so that's very exciting as an investor to try to find opportunities where perhaps the market is missing where we'll land. And as far as my own views go on where we will land, I think that it's very important to understand from a US political perspective that there's a couple of pretty important groups that would be unhappy with the tariffs as currently announced. The auto industry is significantly in the press, and I think it's really interesting that in 2025, we're actually celebrating the 60th anniversary of the US-Canada Auto Pact, which is actually the original agreement that both led to the integration of the North American auto industry, but also provided the predecessor agreements to the original free trade agreement signed in the 1980s. From my perspective, I do think that we will land in a place where there will be some level of tariffs between certain countries. And I think what the market's seeing today is US, Canada, Mexico, as well as China. And I actually don't necessarily believe that this will be the place where we land. There may be some level of tariffs, but where I'm really trying to plan around is where we end up 6 to 12 months from now. And I think the tariff situation could actually be quite different and not as negative as people think for Canada today.
Next, we'll hear from David Tulk, portfolio manager on Fidelity's global asset allocation team, part of FMR, Fidelity Management and Research. The GAA team oversee the Fidelity Managed Portfolio suite of risk-targeted investment solutions, as well as several other funds. David joined Fidelity in 2016 and is also a former economist at the Bank of Canada.
David, thanks for sitting down with me. Let's get straight to it. Your overall reaction to the tariffs that sort of swooped in earlier this week.
As a Canadian, I'm dismayed. I think a lot of us are that it's come to this. But as an investor, I think this was a risk that we saw coming. This was something that we knew would potentially be realized, and it has been realized. And the positioning that we've taken in a lot of our multi-asset class funds anticipates some of the challenges that I think we're going to experience in the months ahead.
Can you dig deeper into what the positioning is for the global asset allocation team and how you sort of pivoted at this point in time?
Yeah, so one of the views that we've had as a consistent position, even before this tariff risk, was concern around Canada. So we've been worried about Canada's economic performance from a lack of business productivity, from some of the challenges that the housing market is facing, as well as levels of household debt. So from an investment perspective, we wanted to be underweight Canadian assets with a preference of being invested elsewhere in the world. Now, the reality of the tariff shock is that it only amplifies some of the challenges that I think the Canadian economy is going to face. Canada is a small open market economy. It depends crucially on international trade. And as you hurt demand for Canadian exports through these tariffs, we have to be suitably concerned that this will also weigh on Canadian financial assets.
So if these tariffs do stick for a prolonged amount of time, what is the positioning of the team going forward?
Yeah, I think if this is a significant shock that remains in place, and I think a lot has to be determined, so we're going through negotiations and we'll see how this all shakes out. Right. But in the event that this does remain in place, I think we're pretty comfortable with retaining that positioning of being very cautious on Canada. I think it's an important thing to realize that there are some economies that will be hurt more, and Canada, unfortunately, is towards the top of that list. Now, an important counterpart to that, and what we're trying to do as we speak, is try to understand, well, where do we want to be overweight in terms of the rest of the world? And for a long time, we've been comfortable being overweight the US economy. That's where the growth was, that's where the momentum was. But at some point, I think we're starting to get some signs that that could be shifting to some extent. So trying to understand where in the rest of the world, whether it be the United States, whether it be in Europe, whether it be in emerging markets, some of those allocations I think are places that we're looking at very carefully to try to understand where there's opportunity.
So lastly, what can advisors take back to their clients in terms of looking beyond sort of the negative headlines and maybe looking at some pockets of opportunities elsewhere?
Right. No, I think there's absolutely a strong incentive to look through as many of the headlines as you possibly can. So a big part of that is really just taking the emotion out of it. And this is an important context in any element of investing, is that these are emotional times. But when it comes to investment decisions, it's really important to just try to understand the underlying fundamentals. So first and foremost, that is the first step. Then second, I think, is really to just retain diversification. No one really has a strong sense of where things are going. So by being diversified, you protect yourself against a whole range of different economic and market outcomes. And then third and finally is really sticking to a medium-term plan. So having a fundamental view around a company and understanding that the price can be pushed by emotion, sticking to that fundamental view can create opportunity for active managers from a security selection perspective. It allows us also as active asset allocators to understand where the market moves too far in one extreme and we can move in the opposite direction. And I think even taking a step back as a Canadian again, this is an opportunity for Canada to really rethink its place in the world. So we've driven our economy largely on north-south trade. And now we need to reconsider what opportunities exist across our provinces and also into the rest of the world. So if there is some adjustment and some pain that needs to be felt, if it can be done in the name of building a more diversified, more resilient economy, that's unambiguously good news.
So still a fluid situation with these tariffs, but really appreciate you sitting down with us, David, and providing your perspectives and insights.
Thank you for having me.
Joe Overdevest has been with Fidelity since 2002 and manages Fidelity Global Natural Resources Fund. Here is what he had to say about the developing tariff story.
What is Fidelity Canada doing to help our clients? Number one, we're using the 400 investment professionals around the world to leverage their resources to do analysis on income statements, balance sheets, and cash flow statements to see if tariff scenarios play out around the world, what is the impact, not just in Canada. This scenario analysis started many months even before the US election because we did not know who would win that election and we wanted to be prepared. Much like a chess player, you want to think multiple steps ahead on the chessboard. We're also tying in CEO and CFO meetings that actually have ramped it up recently to ask them if these scenarios play out, what would be your response? Number two, we're looking at portfolios to see what companies are affected, not affected, or in some companies actually would benefit from tariffs if they're operating in the US, and adjusting the portfolios, our clients appropriately in running these scenarios. Number three, more importantly, is right now, we're being very diligent. We're on the front lines, seeing headlines like you, and we're adjusting our sensitivities, our analysis with our analysts on income statements, on earnings, and also continue to talk with CEOs because it's a very fluid situation. Essentially, this is the job of active management, to be a steward of your capital. So now when we look at the tariffs themselves, we have to understand that sometimes people get emotional or get political, or even worse is they get to the extreme that they only look at the numbers. The honest truth of politics is it comes down to voter base. There are certain voter bases in every country that will be driving agendas. And right now in the US, there are certain sectors that are definitely more sensitive to what is going on with tariffs and driving the agenda of the US. Some of them were mentioned that would be farmers, manufacturing jobs, and so sensitivities here in Canada, which would be then our autos, our steel factories, and also our dairy industry. Some of the industries, though, potentially we could partner with the US, is because they've been very vocal about wanting more energy, in particular oil, uranium, critical minerals. It could be a solution moving forward to some negotiation. Also, for the audience here as our clients, we have to also understand there's two phases of this. Right now we're dealing with the first phase, which is tariffs predominantly on China, Canada, and Mexico. But come April, there is a threat, or at least a potential, that tariffs could go across multiple countries and multiple sectors. And there we also have to watch that as a trading partner, the US may ask us to put tariffs on other countries, but then maybe in response, they have less tariffs with us. This is a very dynamic situation that can affect trade flows. In times like this, it's very easy to say, these seem difficult, these seem volatile times. When you look back at long-term returns, I have to stress, there's usually three things that drive long-term returns. Number one, how long you've invested. Number two, what asset class you invested in. And number three, who you decide to invest with. Again, at Fidelity, we're being a steward of your capital and working very hard, and we appreciate your time. I hope you have a great day.
Finally today, we'll hear from Patrice Quirion, a 20-year Fidelity veteran who manages several global funds.
Over the past few days, the world has been hit by the impact of tariffs coming in. So the speculated trade war has actually taken effect. That obviously plunged a lot of the markets into uncertainty, greater uncertainty that we've seen in quite some time, with fairly significant impacts on some economies and especially some sectors. So what are we doing as portfolio managers through that volatile environment? First, I would say we keep our same long-term view on how developments could go and try to stay isolated from the short-term movements and short-term emotions that are also reflected through that. We continue to talk to experts, to our analysts. We continue to engage with companies. Maybe one difference at the moment is a lot of people feel that uncertainty. This is the case for most corporates as well. So how do we make our investment decisions through this heightened period of uncertainty? I think first we try to understand what are the overall implications of that. And it's no surprise that any tariff trade wars is generally sort of a self-hurting mechanism for the economies involved. So I think we need to be careful on a few points from a macro standpoint, especially for North America at the moment, where I think we need to be conscious of repercussion implications on inflation and what does that mean to interest rates potentially down the road. There's also some really important questions around what does that do to consumer confidence, and maybe most important of all, to corporate confidence. I think one thing that is maybe not talked about sufficiently about the potential negative impacts is just a freeze on corporate decision making that we could see going on for some time. And obviously into any economy, if you have a freeze on decision making, no new investments sort of going through or purchase decisions that are being pushed out, that has the potential to create a little bit of like an air pocket for the economy, for markets. So all that to say, I think we need to be mindful of the potential negative implications at a time where markets were generally fairly in favor, relatively expensive, especially in the case of the US. So I can say in my case, I'm approaching that with a much more risk-off, careful stance. But where it differs, maybe than the general implication is, or the general anticipation by most, is that there are some sectors or subsectors of the economy that are seen as very impacted. Think of the automobile sector as one among like quite a few different sectors where the implications are more dramatic. And then there are sectors where the implications are lesser known or less in the spotlight. And I think the risk, if anything, might be more on the second group of less impacted sectors, simply by the fact that the tariffs as proposed today are simply too large, too impactful, too detrimental on both sides of the border for the most impacted sectors. So I think if we think of autos or energy, I think it is very likely we'll see diluted tariffs if they were to stick at all, as opposed to like starting to ask questions where maybe most investors are asking fewer questions about potentially less impacted sectors, but where the tariffs could actually remain in place or be less diluted over time. I don't think anyone has the answer to how long will those tariffs be in place, to what degree are they a negotiation tactic to extract something else. But I think we need to play with scenarios more than ever, and this is what our team of analysts across the globe is helping us to do. The last point I would like to make is, although a lot of the focus is on North America at the moment, on Mexico, Canada, let's be realistic. The next countries to be targeted will be increasingly in Asia and Europe. And the message I would like to leave there is there's already a lot of fears embedded in the market as a result of these potential tariffs or a more hostile US administration towards Europe and Asia. As a result, a lot of these markets had been heavily discounted over the past number of quarters. And the rest of the world will not stand still in face of that. We are already seeing some good examples through new measures in China to stimulate the economy, and really an unprecedented set of measures put through by Germany following their election, partly as a result of building resilience versus maybe a more difficult export environment to the US. But these have the potential to be, on one side, less priced in by the market, at least initially, and have the potential to be of greater magnitude of importance relative to the impact of tariffs. So as an international global manager, a lot of my focus remains on trying to find opportunities in the rest of the world where tariffs may have less of an impact and where domestic countermeasures may have a greater impact. So let's take that volatility as an opportunity, as it is always the case for most contrarian investors. And I feel that we are into a pretty good environment to find dislocated stocks, while we need to be mindful and keep maybe a little bit more of a risk-off approach on the most central part of that, which is North America at the moment.
Patrice's comments are also available in French. Please head to the Insights section of fidelity.ca for that video. So, thanks for tuning in today. I hope you found that insightful. Again, this is a developing story, and we hope you'll join us again for ongoing commentary. Advisors, our live Fidelity Connects webcasts are every day at 11:30 a.m. Please reach out to your wholesaler for more information on how to register. And for the investing public, please follow Fidelity Canada on LinkedIn, YouTube, and Instagram, as well as our Fidelity Connects podcast, which are video podcast replays of the daily webcast. Thanks again. I'm Kyle Sharapata. Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.